when dealing with them. Next, we'll talk about keeping a budget. Obviously, a budget is a very important tool when you're talking about financial literacy. So we'll touch a lot about budgets, what it takes, what does it mean to keep a budget. Some people are sort of they either underestimate the importance of it or intimidated by the fact of trying to keep a budget. They think it's something for the wealthy or it's something for companies, but it really helps everybody. Item 7 will be building wealth. We'll talk a little bit about the nature of wealth. When do you really feel wealthy? What does it mean to be wealthy? And how does one achieve that goal, if it is a goal, or is it actually a process? Next, we'll be talking about the difference between buying and investing. And lastly, we'll talk about some financial terminology that we will all benefit from in this presentation and in the future presentations that come up. What I'd like to do is, as I go through each topic, each slide, some topics take more than one slide, but for the most part, each topic is presented in a slide. I'll pause afterwards and see if there's any questions on that slide specifically before we move on, so you don't have to remember your questions at the end. And I know Sabil and Adita have another format that they may ask questions later when during a break or something. So just you'll have opportunities to ask questions, I guess, is the bottom line. So let us proceed. Bismillah. The first item is understanding money and the proper relationship with it. As a definition, money is actually a measurement of value. So when one says it is a measurement, we can look at an example. If I tell you I weigh 200 pounds, and I wish it was 200, but let's say if one says I weigh 200 pounds, you can visualize what the pound is. So 200 of that, it's a measurement that is known. It's something that you understand. So money's goal is to provide a common understanding of a measurement, and it's a measurement of value of something. So when I say a pen is worth $10, then you would understand that that's the value of that pen. If I said it was 10 pesos, and we're talking in America, or we're talking in some place that doesn't know the pesos, it wouldn't mean as much. So the important thing about money is it's localized, and it's a measurement of value for that area that's talking about it. So that's one of the very first important things to look at. And money, of course, is not only currency. There's many different forms of money. In the old days, there was bartering. There's many things that were used as money, and we'll talk a little bit about that. Important thing to keep in mind is money is not the end goal. And that's really very important for people's happiness. Sometimes you ask people and they say, oh, I work for money. I'm working to make a living. You're actually not working for the money. You're working for the things that the money will provide you. So the money is the means that give you the end goal, the things that you will bring you pleasure, bring you happiness, and allow you to exist and live productively. So money's earned. It is not really made, unless you're one that's in the crypto business and mining crypto bitcoins. Money is earned, and you earn it by providing a service or by selling a product. But it's something that is earned. You work in it, and you earn it. with the goal, not that you'll stop once you've made $100 and you put it in the bank or put it under the mattress. Your goal is to get the $100 to be able to buy food and other things that you need. So it's a tool for buying things. So it's a measurement of value, and it's the tool that allows you to buy things. One important thing that people misunderstand sometimes is money is a measurement of the person instead of a measurement of a product value or a service value. A person that has $100 is not less valuable than a person that has $1,000, and a person that has $1 million is not more valuable than a person that has only $100. So the measure of a person is not how much money that they have, but it's the collective. The measure of a person is the collective acts and deeds that the person does with and without money. So important to keep that in mind for the happiness. For our happiness as people, especially for young people, and I don't know if we have young people on the presentation, but this is really something that college students and younger really need to appreciate, is that you will not be necessarily happy if you have $1 million or $10 million or $1 billion. And it does not make you the king and does not make you the important person. The importance of a person and the measure of a person is their actions and what they do with their skills, their time, and whatever resources they have.
Unfortunately, that's not the reality of the world, Mike, right? People are
I
measured by
know,
how
but
much
that's why
money
we
they
need
have.
to.
And so we're trying to put a new twist on it and tell people, like, this is not a measurement of your quality of the person that you are, but unfortunately, the world revolves around money, sadly as it is. One of the things I'd like to do is do a housekeeping call right now. If you have a question and you're not courageous enough to unmute yourself and say it out loud, please go ahead and on the bottom of your screen, you may see something called the chat. And if you hit the chat button, you can go ahead and type questions in there, and I'll keep a record of your questions. And when we take a break, I will go ahead and address Mike with those questions. So either way, you can either raise your hand and say, I have a question. There's another um, um, option at the bottom that says reactions, and you can actually, if you click on that, it says you can do some things like um, let's see, in the reactions you have check marks, there's a clap, there's a thumbs up, and there used to be a raise my hand. There's a raise my hand tab at the very bottom, and you can raise your hand and I'll know that you have a question, and I'll go ahead and pause mic and we'll address that question. So just some housekeeping um, right off the bat here. Please continue, Mike.
Thank you. Thank you so much. So if we look at the history of money as the next item, money is not always the currency that we have now, which is called fiat money. But in fact, it started out as commodities, whatever people had to use to barter with. And that is a form of money. It's something that has value. It's something that you can trade with somebody else. So in the Islamic history, there are 6 types of known commodities that were commonly used as money. There is gold and silver, which are the precious metals. And then there is commodities that are like wheat, barley, salt, and dates. And I found that to be rather ironic, dates, but it's the things that were plentiful at the time. And you could use them. Most people can use them, and their value was somewhat known, and it kind of held value. So you knew that with wheat you can with a certain portion of wheat you can trade it for barley, you can trade it for salt, you can trade it for dates, you can trade it for gold or silver. So those were the sort of the sanctioned commodities or money in the history of Islam. As societies progressed, gold and silver became more prominent and the easiest things to use in exchange for other things, whether it's the wheat and barley or for services and things the like. But the issue with gold and silver, actually with all those commodities, the storing them safely, carrying them. And if you have a nugget of gold or a bar of gold with you and you need to buy something that is not, doesn't consume or doesn't need that full amount, how are you going to chip the gold to the piece that you just need to spend at that moment? So fiat money was introduced, and fiat doesn't have anything to do with the car, the Italian car. It is the fiat is just referring to a money by decree. So it is something that is issued by an authority, and that authority says, we deem this as a legal tender. It is the something of value. And in order to get acceptance for the paper that the legal authorities were saying, it started out that these things were tied to usually some precious metal, and that used to be gold. So typically the dollars that were issued, say in the US, either were backed by silver or gold. And after World War II, for those of certain age and history students, the U.S. was actually on a gold standard, and the U.S. dollar was pegged to 35 U.S. dollars were pegged to 1 ounce of gold. And at any time, anybody can take 35 US dollars and get 1 ounce of gold. That from World War II until 1971 in the Nixon administration, and I remember that maybe some of the younger people on the calls, and this call may not remember that, but I remember those days. It doesn't seem that long ago. But in 1971, Nixon finally ended that parity and started what is called the debasement of the dollar. And basically it's the dollar is what people value it as now, and not tied to gold, not 35 to the dollar or any ratio to the dollar. Just as a piece of fact, that at the time, 1971, a dollar was 35, an ounce of gold was $35. Today, if you had 100,000 1971, and you know the gold now is $1,900 an ounce, over $1,900 an ounce compared to $35 an ounce. So if you had $100,000 in 1971, the equivalent amount you need to buy the same amount of gold today is $5.4 million. You can imagine that difference, and that is owed to inflation. So that green dollar that we're holding now, that looks the same as the one we held in 1971, actually is worth much less than it was in 1971 when you compare it to gold, when you compare it to silver and other commodities.
Wow.
So,
wow, that's amazing, Mike. I have a true and false question for the audience to test your attention spans here. True or false? Money is made, not earned. Type in your answers into the chat box, true or false, everyone. Money is made, not earned.
Oh, I don't understand the questions.
Huh?
Nothing. I'm just talking to myself. Talking out loud.
Tab,
I'm gonna mute
put your
myself.
answer into the chat. Put your answer into the money is made, not earned.
How are we doing? Is it looking
So
like we're losing
a
people
few.
already?
We have currency is minted, money is earned. We have Zainab says it's true. Zach Cook says it's true. Marwa says it's false. So the correct answer is Mike.
False.
False.
Money is earned, not made.
I tricked you guys. I tricked everybody.
Money is earned, not made. Remember, you don't make it, you earn it. Only the Federal Reserve Bank makes money because they print it. And those that mine crypto, if you consider cryptocurrency money, then they make it by mining it. Very good. So that's the end of this slide. Before I move on to the next
We have
slide.
one question. We do have one question.
Oh, wonderful. Let's
Yeah,
have it.
Summer says, thank you, Mike. Money is a mindset. We receive a lot of this mindset from our family and environment. How can one change this mindset that we are much more than our checking account? Is this a question for this forum, or is this a psychology question?
It's a very deep question, and it's really
Well, I think
wonderful
Mike has been in the industry for so much longer than any one of us. And I think you can guide me, Mike, that we're not what we our bank account.
It really is an uphill battle, and you have to start within the family, like every teaching opportunity when the children are young, and just teach them the value of money, and the fact that money is a tool, not the end goal. The society all around us, the commercials, they glamour the money, the fast cars, the beautiful clothes, the mansions, and they make you believe that if you have that, you're happy and you're better than everybody else. So it really takes either Psy, the course of Psy, which helped me quite a bit, by the way, or the families just working with their children and teaching them that at home, and overcoming the bombardment that you see outside.
Okay, thank you.
You're
We'll
welcome.
have to definitely do classes tailored to the young
Yes,
as well.
Inshallah, inshallah. Okay, so next we'll talk about credit cards. Credit card, what is a credit card? A credit card is sort of an IOU. It is a flexible and unsecured loan that usually a company is happy to issue to you. It is a guarantee. So when you want to go and buy something from a grocery store, you don't want to use cash, you don't have cash, so you tell them, I will buy and I promise I will pay you back. The store is likely to say, I'm not sure I want you to walk out of here with just a promise. So you would go to Visa or Chase or one of the card issuing companies, and you say, would you guarantee my IOUs? Would you issue the card that allows me to promise people that they will get paid? And you, as Chase or Visa or Amex or whoever, you trust me, you will wait until I pay you back. So that's what a credit card is. It is an IOU, and it's a guaranteed IOU by the issuer of that card. There's two types of cards that one can get from the bank. There is a credit card and a debit card. The primary difference between those two is the time of payment. A credit card, most of us are familiar with. You go make your charges at the end of the month. You get a statement that tells you, oh, by the way, you've spent $1,000 this month at these different places, and we'll give you 25 days, which is by law what they're allowed to do. They have to give you have 25 days to pay this bill. And if you pay it in full, we're not going to charge you anything. If you don't pay it in full, we're going to charge you an interest on it, which is how credit cards make their money, in addition to the upfront fee that they charge. So that's the credit card. So there is delay in payment. You charge something, you get the statement, you have a grace period to pay. Once you pay it, that's when it's finally settled. A debit card, on the other hand, is usually issued by your bank where you keep your checking account, and the money goes right from your account as soon as the merchant uses it, as soon as they run it. So it is a much quicker time to pay. You don't have to wait for a statement at the end of the month. You run it through and it takes it right out of your account. There's different uses for those two cards, two types of cards. The main benefit of a credit card, of course, is that you buy now and pay later. The biggest disadvantage is if you don't pay it now, like a debit card, what if you won't have the money later? Maybe there's a temptation that by the time the credit card statement comes, oh, you guess what? You've spent the money you had in the checking account that you would have used to pay this credit card bill. So the advantage of a credit card is it gives you that additional time, and you don't pay interest for it as long as you pay it at the end of the month. But the disadvantage, it requires discipline in making sure you don't use it for things you don't have money for. The debit card restricts you and gives you that discipline, because when they run it, and if you don't have the money, you're not walking out of the store with whatever you were trying to pick up. So that's one of the important distinctions between credit cards and debit cards. Another benefit of credit cards is it builds history. Why? Because remember, it is an IOU. When you tell the credit card company, I promise to pay this amount when you send me the bill, and you go charge, they send you the bill, you pay it, they report it to the rating agencies like Equifax, Experian, things like that. So that history of borrowing by using your credit card, running up a balance on it, and paying it at the time the statement comes, gives the credit repositories an idea of your ability to manage your IOUs, the ability to manage your debt. So the more you do that, the more you use it and pay it on time and keep the balances low, the higher your credit score gets, because they consider you a responsible person. If you don't make your payments on time, or you let the balances run up high and you make a minimum payment sometime, you don't make a payment another month, then the credit scoring engines will look at that and say, this person is really not very responsible with their money. We cannot give them a high score. So it's just like school. You do well, you get an A. You miss a few, you get a B. You miss a few, you get a C, etc., etc. So credit history is one of the main benefits of using credit cards. The recommended use for credit cards, particularly for younger people and particularly for people who are not very financially literate, if you will, credit cards use is really for short-term needs and emergencies. Do not reach for it to buy a piece of furniture that you plan on paying over a period of time. Why? Because the costs are very high. Credit cards, because they're unsecured, because the companies don't know if you're going to pay or not, have the highest interest that they charge you for that. I've seen interest as high as 36%. They may lure you in with a lower rate up front. They may give you an option to say, oh, this is zero interest for the first 6 months or 12 months or whatever. And then it goes up to 18, 20. And if you do not have good credit score, the starting rate that the credit card companies give you is going to reflect that poor credit, and they'll ask for higher interest. The highest I've seen is 36%, but I'm sure it goes up higher if you don't pay your bills on time. And of course, if you don't pay your bills on time, they'll ask you for collateral. So those are another type of credit cards. They're called secured credit cards. Well, they say you have to put $1,000 in an account, say, and they'll give you a credit card for $1,000 to make sure that if you don't pay, they'll get the money from the money that you set aside as collateral. So short-term needs means you use the card only for what you plan to pay at the end of the month and what you can pay at the end of the month. So if you have, you're going to have $100 to pay at the end of the month, do not charge more than $100 on it so that you can pay it off and you get good credit history, good credit score, and you don't have to pay the exorbitant interest that they tell you. And many people do not look at their credit card statements. Now the law requires the credit card companies to tell you if you paid the minimum payment only, how many years it would take you to pay off this debt. And you would be aghast just looking to see how many years one would take to pay off $2,000 or $3,000 or $4,000 debt when you add in all the interest that's there. Of course, we also say for emergencies, because emergencies come up. I'll give a few tips later in the presentation about emergency funds. But if something comes up beyond your ability to pay for it from salaries, then you have to use it and make the intention to pay it off as soon as you can. That's the most important thing to say on that. And because credit cards are so expensive, it is good to shop for it. They lure you with lower upfront fees. They lure you with rewards. They have credit cards now that give you everything: airline miles, cash back, benefits, entrance to certain airport lounges, all kinds of rewards based on your needs and lifestyle. But they all have a cost. And the savvy person is the one that shops for the best rates, that shops for the best rewards, and really uses the card that fits their lifestyle. What are you using this card for? Are you using it for travel expenses, for business expenses? Are you using it for groceries and gas? Then maybe the cash rewards would be better for you than airline miles. It depends on what your lifestyle and your needs are. So that's credit cards. I will stop here briefly and see if there are any questions on this slide.
Okay, so thank you, Mike. Another true and false question. Please type your answers into the chat box. Credit cards help only build your credit. True or false?
We need some background music like Jeopardy or something.
All
right, how are they coming?
Okay, so as the question was asked, can you repeat the question? Credit cards will only help build your credit. That is the question. Is it true or false? And we have kind of a tie with true and false answers. We have half the audience saying true, half the audience saying false. Mike, what is the correct answer?
It is false because it's one of the benefits. If you look on item 3 and 4 on the slide, those two are benefits. Allows you to buy now and pay later, as well as it helps you to develop your credit score. So it is not the only, as Adita is good at asking you tricky questions. Sure you understand and
I was
follow
also
carefully.
thinking that it could destroy your credit if you don't pay on time as well, right?
Of
So it's not
course,
just
of course.
upwards, it's also going to take you downwards if you charge something, not pay it, and you consistently not pay it off, then you can actually destroy your credit, correct?
Absolutely. Absolutely. It can build or destroy.
Okay. Okay, very good. So then the follow-up question here is from an audience member, we won't say who, is how can we build credit? And then which company or which credit cards are best at giving you, helping you change your credit card score, your credit score?
Um, if I understand correctly, how to build credit, you just have to start. You start by the easiest credit card you get for a department store or a Visa. And luckily, credit is very easily now obtained. You get these credit card offers in the mail. You get, there's competition. The easiest way is to check with your bank, wherever you bank. Ask them, say, do you offer a credit card? Do you have a sponsor that offers credit cards to people that are starting out? This is where you have your bank account. You're already known to the bank management, and that would be the easiest credit card to get. Other than that, the second easiest is generally jewelry and furniture places. So you go to Ashley and you want to buy something, Ashley Furniture, and you tell them, I'll buy it on credit. They're more than happy to open a credit card for you to sell you the product. And that helps establish credit. So jewelry and furniture are the two easiest, but they're not the cheapest. The cheapest is probably going to be from the bank where you're banking, if they offer credit cards. There was a second part to the question. Do you mind repeating that? I think I
Yes,
missed.
which company can we use to help change our credit score? You kind of mentioned
Oh,
jewelry
yeah,
and furniture.
changing the credit score is a function of, there's companies that specialize in changing your credit score. If you find yourself in a way that your credit is hurt, it's some bad things have happened to it, you have a low credit score, it is good to first of all get the credit report, get your own credit report to see what is causing the problem. And then you have two options. There are nonprofit companies that are called credit repair companies. And those nonprofits, they don't charge you anything for that service. And they will work with you basically by communicating with the vendors that have posted the bad credit, and they try to help you resolve it. If it's a bad report, sometimes it's not your fault. You didn't know the bill was there. It's actually not yours. This is somebody else's debt that they mistakenly added on your credit. So there's a number of reasons why a derogatory credit can be there. So the nonprofit companies are one way to do it. They take the longest time to do it because, frankly, they have too many customers. There's also companies that for-profit attorneys and for-profit credit repair companies that will help you change your score. Some of those are a bit unscrupulous. They charge you upfront, and the benefits that they give you may not be long lasting. So I would discourage from using the for-profit credit repair companies, even if they're an attorney. I would say either work with a nonprofit or get the credit card statement. Every credit report will tell you the phone number and address of the vendor, of each vendor on the report, and then simply contact them and say, you're showing there's a collection here that that I haven't paid you. I didn't know it was there. How can I take care of it? And by taking care of it, usually they want you to pay it. You can either pay it in full or you can negotiate a reduced amount, especially if it goes to collection. When it goes to collection, they're more willing to accept less than the full amount. But the most important thing to change your credit score is to ask that company to delete the derogatory reporting upon your payment. So when you're negotiating with them, you say, okay, you show I owe you 2,000. I'm willing to pay you the 2,000, or I'm willing to pay you 1,500. But on the condition, I want you to take it completely off my credit. And if they agree to do that, many do, but the larger companies don't. If you're dealing with Chase, Citibank, things like that, most likely they will not take it unless it was an error. You can show them there was a reason it was not paid. But collections, medical collections, some of the smaller companies, yes, you can definitely, gyms, cell phone bills. Incidentally, those are the most common contributors to bad credit. Gym memberships and cell phone plans and cable service, because people get angry at the service, cancel it, and they don't pay. And guess what? It just goes on your credit and hurts your credit score. And it really impacts your ability to get credit in the future at a reasonable cost. I hope I addressed that enough.
Yes, you did. Yes, thank you so much.
Thank you. Okay, so credit history and score. We mentioned the credit score that you get from Experian, TransUnion, and Equifax is what it boils down to really is a measure of your character, your ability to meet your obligations, and your responsibility as a person that can manage their obligations. So it is a measurement of character and responsibility. So unlike money, the more money you have does not mean you're a better person. With credit score, the higher score you have means you are a person of integrity and a person of responsibility, at least in the eyes of the credit card companies and the lenders. So you may have $1 million and have low credit score, and the lenders would look at you as a person of questionable responsibility. And you may have $10 to your name, yet have a credit score of the top levels, and everybody will be chasing you, offering you to borrow from them. So credit history is a measurement of your character and responsibility. And knowing that, you want, of course, to make sure that it's the best. It is the best that people can view. And if there's any problems with it, you want to fix it. Credit score is also established over time. You do not earn it overnight. You don't open a credit card and bam, you have top credit scores. It takes time, and it takes usage. So you have to borrow and pay back, borrow and pay back, borrow and pay back to show your responsibility, to show how you pay on time and things like that. And of course, the credit score affects your credit history. We talked about that a little bit. If you have high credit scores, you're going to get the zero interest offers for 12 months and 24 months and things like that. If you do not have the good credit score, they'll start you out at 18 and 24 and 36%. So it definitely impacts your cost the interest that you get charged, the APR, and it is an important factor in loan approvals. So not just credit cards, but if you're trying to buy a home, you're looking to get a mortgage, you're trying to buy a car, you're trying to get any kind of a loan, a business loan, your credit score is a very important factor. It is not the only factor, but it's near the top. The top factor in any loan is your ability to pay back. The second is your credit score, and it's almost head to head because you have to show the ability to pay. And then what have you done in the past with other debt that you've received? That's what the credit score says. So the lenders are going to be reluctant to give you more or new credit if you show that you have mismanaged your credit in the past. When it comes to credit score, the top tier credit, most people ask about that. And when you hear car ads, for example, they tell you a payment as low as $299 per month to lease a Honda, and it's for top tier credit. Top tier credit is defined as 740 and above. So anybody that has a credit score of 740 and above would be considered top tier. And by the way, your credit score differs from company to company. So Equifax may have a score of 740 for you, and then you go to TransUnion and you find your score 800. You go to Equifax and you find your score 690 or 680. Why the difference is? It's because each company, number one, has different formulas that they use, and because, most importantly, because not all vendors report to all companies. So you may find Kohl's, for example, you use Kohl's and they report to Experian. They don't report to Equifax and others. So if you have more debt being reported to one credit repository, Experian, for example, they're going to be able to assess your score and your history differently than if you only have one company reporting to Equifax. So Equifax says, well, he only has, or she has only a few obligations. We can't determine a history yet, so the score will be low. But if Experian, more people are reporting to it, they'll have more history and they'll be able to give you a higher score. So most lenders, not vendors like people that sell you clothes and restaurants and stuff, but lenders, they use all three companies, Experian, Equifax, and TransUnion. And they will check with all three of them. And usually the standard in the industry is they toss out the highest and lowest and use the middle score. So when a person says my score is 740, is really they're referring to their middle score being 740. It is not the highest or the lowest. That's the end of my credit history slide, and I'll be happy to entertain any questions.
So I have a question for you, Mike. When I was young and I was in college, I really wanted to buy a car, and I found this beautiful Jeep Wrangler that I really had to have, and I went to my parents. I said, "Give me the money, and I'll pay you guys back." And they're like, "Nope, nope, you're gonna have to start doing things on your own." So I said, "Okay." So when I went to this dealership and I said I'd like to purchase this car, it was the interest was so high. They were going to give me, because I didn't have any credit, the interest on the car was going to be like 21 or 22%. But I
Right?
had no other option because I didn't have any credit. So I purchased the car. I think it was $5,000 at the time. I ended up paying $8,000 total by the end. And so did that help me build credit eventually? I
Absolutely.
don't really know. but I ended up paying more because I had to pay interest. And then by the time I paid it off, so we have a lot of clients at Sabile that come and they don't really have any credit. And when they go to make a purchase, these companies don't really give them a lower interest. They give them a really high interest loans for whatever they're purchasing. Would that be a way for them to build credit if they steadily pay on that?
Exactly. You build credit by taking credit, by using credit. So if somebody is starting out, my recommendation would be they get the car at whatever rate they're able to, um, demonstrate the responsibility by making their payments on time, and then refinance. Don't wait until the end of the 3 years or 5 years or 6 years term of the loan. You can refinance it after 1 year. Once you've established the credit score, then you can either go back to that company and say, hey, I would like to renegotiate, or I'm going to go somewhere else and refinance. And that's the best way to lower your cost. So you will have to pay, unfortunately, more upfront if you don't have any existing credit, because they're taking a chance on you. They're not sure if you're a good risk or not. But you do not have to stay in that contract for a long period of time. And then actually what you mentioned brings up another question. There's different types of debt. There's credit cards, which are due every month. And then there's installment credit, which is paid monthly over a period of time. Each type of that credit affects your credit score differently. So you can try to get a credit card and then an installment credit like a car loan, and then refinance it, things like that to build your credit. But you don't have to have an installment credit. If you wanted to start by 1 or 2 credit cards and then wait 5 or 6 months and then go apply for your first car, you'll be in much better shape from a credit score standpoint.
Okay, fantastic.
Any other questions? Okay, next segment is on banks, developing relationships with banks and the importance of that. First, let us define what banks are. Banks, or their legal term is actually depository institutions, are businesses that are formed to use the savings of the community. And they provide a service, they provide safety and convenience. The way the bank works is that it takes the deposits from the community, uses those deposits to make money in the form of loans, credit cards, lines of credit, things like that. And then the profit that it earns, it covers the overhead and then pays interest back to the depositors. So that's the simple way that a bank works. It gets deposits in, uses the deposits to make money, and the money it pays back to the depositors. A finance company, by the way, is not a depository because they cannot accept deposits. So the federal government and the state governments have defined a bank as a depository institution that has the ability to do that. And if you do take deposits, in order to protect your depositors, you have to have either FDIC insurance or credit union insurance, etc. So banks and credit unions are depository institutions. And the main goal is, like I said, rather than keeping money under your mattress or in your home, there's safety and convenience. You put them in the bank, you don't have to worry about somebody stealing them from your home, or the home burning down, or you lose it, or you forget where you put it. And convenience, you don't have to carry it everywhere you go. You go out about your business, you find something you need, you either use a debit card, a credit card, or write a check, and the bank will pay that vendor on your behalf. So safety and convenience is the benefit of the bank. When we think of types of banks, there is traditional and online. And the online banks for the younger people on this podcast and the presentation, they appeal much more to younger folks than old folks like me. The online banks, they tell you, you don't have to come in at all. We'll give you all the tools you need to do your banking online from their app or from your computer. You can take pictures of your checks, you deposit them, you make all your transfers online, or you use Zelle or any service like that, and you have no option, sometimes no option and no need to even go into a building as you see. A traditional bank would be something like, say, a Bank of America. You see them everywhere. They advertise actually through their branches. So the reason Bank of America has so many branches and Chase is building all these branches all over, it's advertisement. They get depositors by having these branches. Online banks don't rely on the brick and mortar of the traditional banks to get their deposits. They get their money by reaching customers online. So in order to fend off the competition, the traditional banks now offer all the online tools that the online only banks offer. Some of the online banks, by the way, like Capital One. Capital One started out as online only, and then they started opening branches, and now they're changing that strategy again and focusing more online. Another one that you may hear of is SoFi. SoFi is another online lender, and there's so many that are coming up more and more. So online banks, their focus is to deliver their products online. They're not looking for you to visit them. They don't want you to visit them. They prefer you use the technology, the fintech, the financial technology, to conduct your business with them. And in order to entice you to do that, they offer you special pricing, discounts, etc. The traditional bank appeals to people that want to go see their money. They want to go into the building and look at the vault, and you see that big vault door, which is actually a facade because you don't really have your money in that vault. They have some money, but it's not the money that you put in. But that's the different types of banking institutions, whether they're traditional or online. There's within the financial institution segment, there's also banks and credit unions. The main difference between those are banks, anybody can go open an account. You decide a bank open next to you, or you move next to a bank, you simply walk in and say, I want to open an account. A credit union is an affinity organization. Credit unions are licensed and given the ability to operate based on a certain segment of the population they want to serve that qualify to be members of that credit union. So for example, the school teachers credit union is a credit union that caters only to school teachers and their families. If you're not a school teacher, you cannot use it. Boeing Credit Union is a credit union for Boeing employees and their families. If you don't participate, you cannot. If you're not a member of that group, you cannot. So the difference between credit unions and banks, credit unions are for certain segments of the population. Another big difference is that credit unions are owned by the depositors, whereas banks are owned by shareholders. So let me elaborate a little bit on that. in order for you to be a member of a credit union, you have to meet two conditions. Number one, you have to be a member of the group they're designed to serve. And number two, you have to buy a share in that credit union. You have to become an owner in that credit union. So they're a mutual organization, and that's an important term. Mutual organization is it's an entity formed by a group, the depositors, for the benefit of the depositors. And because of that mutuality, most credit unions are non-profit. They do not pay taxes because they're formed for a specific purpose and they provide services only to that group. There are a few exceptions that are for-profit credit unions, but for the most part, credit unions are mutual organizations. Banks, on the other hand, you could own shares in Bank of America without having an account at Bank of America. You can have an account at Bank of America without owning shares of Bank of America. So the banks are formed differently. They segregate the shareholders from the depositors, and they serve everybody. Credit unions, they specialize who they're going to serve, and they require that those that open accounts also become owners of that organization. That's a kind of a tricky item for people that are not very familiar with the two entities, and I'll be happy to answer questions on that. For the most part, I'm sorry, go ahead.
No, sorry. I have a quick question. Since we do have some Sabeel clients here, I'm wondering if we could speak a little bit about what are the requirements to actually to be able to open a bank account. Do you have to be a U.S. citizen? Can you only be a resident? And if you're not a resident or a citizen, can you still open a bank account? And then what types of documentation might be needed? Because some people don't really know how to walk into a bank, what's necessary, and some people are hesitant to just walk in and open an account.
Sure. The main thing is you have legal residency in the US to open an account. You have a way to get to your money because banks usually do not serve people overseas. You have to have a way to get into the US. So whether you're a green card holder, whether you're asylum holder, you have a legal way, some sort of a work visa, you have a legal way to be here. And actually, I will address in my next slide what you need in terms of ID. So if I may just postpone that a little bit,
Yes.
I'll answer the rest of that in a bit. But the most important thing, you have to have legal residency in the US to open an account. And of course, you have to be able to identify yourself. So you're going to need ID. And I'll go into more detail in just a little bit. So we talked about the differences between banks and credit unions. As far as our audience here, both entities, banks and credit unions, can serve their needs. You can open an account, you can get a loan, you can get a car loan, you can get a credit card, you can get a home loan from either of those institutions. And actually, you may be able to get lower interest rate by dealing with credit unions than you do with a traditional bank. So it's something to consider. Some people also, from a social responsibility point of view, prefer the mutuality aspect or nature of a credit union and prefer to work with a credit union compared to a traditional bank. So that's something to keep in mind. Certainly shopping around is always encouraged because everybody has to compete. So if banks know that credit unions are offering generally lower rates, they may run specials. They may say to people, if you have good credit on this type of a product, I will beat whatever offer you have. So it's always good to look around. In terms of the accounts that you can open the same accounts in both checking accounts, savings accounts, IRAs, any type of account that allows you to set your money aside and earn a profit on it, you can do with both entities. One word of advice when you're dealing with a bank is to keep separate accounts for separate purposes. Here I say keep your personal and business separate. That's one way. But also, you may have separate accounts, for one for household expenses, another account for your savings. You may need an account for a future trip that you're going to have. And separate from all your other savings, you're setting aside money to buy something. So it's good to have a separate account for that. Accounts are relatively cheap. The more business you have with the bank, usually that lessens the charges that the bank will charge you or the credit union will charge you. So it's always good from a budgeting standpoint to have separate accounts for your separate needs. Now, looking at, I've just switched the slide, looking at savings account, the different types of accounts that you have. Checking accounts, of course, are the money that you're going to need every day. So you put it, you write checks against it, or you use a debit card against it, or you pay online, use your bill pay feature of your bank. It's for your everyday use. Savings accounts are accounts where you would put money for things you don't need to pay bills for right away, that you can set aside either for emergencies or for things that you will need in relatively short term. I'm looking to buy a car in 6 months, so I deposit money for the down payment in it. Or I'm saving to get married, I'm saving for an apartment. So it's things that you save money aside for a period of time, not for years to come. And the savings account allows you to earn a profit. Most checking accounts do not allow you to earn a profit unless you keep a high balance in there, and that, quite frankly, doesn't make sense. Why would you keep money in a checking account when you can put it in a savings account and earn more profit on it? So anyways, that's the use of a savings account. So we have checking accounts for money you're going to need right away, savings account for things that you're going to set aside for emergencies or for short-term goals that you want to reach. And then there's also retirement accounts, IRAs, individual retirement accounts. Those are for longer term. So you set that aside because in 20 years you're going to need it, in 30 years you're going to need it. And when it comes to retirement, by the way, you have different options. You can invest in the stock market, you can buy bonds, you can put it in the bank in an IRA. So there's different options where you can keep your money, and a good financial advisor will tell you you should diversify, meaning don't put all your eggs in one basket. You need to have some money in an IRA. And a bank IRA, by the way, is not invested in the stock market. It's in a CD, a certificate of deposit, that sits there and earns a predictable income on it, and a guaranteed income. The stock market investments are usually through brokers, and that's a different type of investment. So for your retirement accounts, you should have some investments in the stock market, some investment in bank IRAs, etc., etc. Now we come to the question that Aditya had a little earlier. What form of, how do you open an account with a bank? How do you establish an account? What do you look for? So we talked about the first thing, and I actually don't have it here, is your legal residency in the US. You have to show that you're legally here in the US. Number two, you have to have 2 forms of identification. It does not need to be a driver license. It can be a California ID. It can be a passport. It can be anything that identifies who you are. Also, if you're establishing some kind of a business account, they're going to need to look at your legal documents that talk about the business you're trying to open. If you're anytime you're opening a business account, you need to show them that you're authorized to do that. And if there are any permits or licensing required, you need to show that paperwork to the bank as well, so they know they're not aiding and abetting in having you do something illegal. Banking business is very heavy from a regulation standpoint. And the bank's main concern is that they do not aid and abet a person in conducting any illegal activity. And one of the illegal activities that people do is money laundering. Money laundering is they generate money through illicit activities, illegal activities, and then they deposit it in the bank, and that makes it washed, puts it in the system and makes it clean, and they can use. So the bank is always on the lookout for this activity and making sure that they know who is the person opening the account, what kind of business do they have, how are they going to use the account, what is a typical deposit, and if you deposit cash or do you usually deposit checks? If it's cash, how much are you going to be depositing? And there's certain protocols that they do. Before you open an account, banks are required to check OFAC, which is the Patriot Act requirement, to make sure you're not a person on the terrorist list or a person that is not allowed to have any accounts in the United States. They will also check with a system called CHECS system, and CHECS system is a cooperative that all the banks report to, not credit card and debt activity, but they report when a person abuses a checking account that they have. So if I have a checking account and I run overdrafts all the time, or I run an overdraft and just disappear, do not take care of it, or I perpetuate a fraud on the bank, the banks report to this entity, CHECS system, that Mike Abdullati has done something wrong with this account. If Mike Abdullati goes to Chase to open an account, and I show them my IDs and everything, they check their CHECS system, and they come back to me and they say, we noticed that you had a problem with Bank of America. Can you tell us about that? What happened? Why did it happen? And they may quite simply say, no, we don't wish to have your account with us. You're not a trustworthy type of a person. So the requirements from a bank standpoint is identification, residency, checking OFAC, and understanding how you're going to use the account and is it being used for legal purposes.
Awesome.
I'll pause here and answer any questions on banks and developing a relationship with a bank.
Okay, we don't have any questions typed in from the audience, but I have another question, true or false, for you from a few slides ago. And the true or false question is, I can negotiate with a creditor to bring down the payment that I have to make to pay them back. For example, if you have a negative score in a credit report and you look at your credit score and it's because you didn't make payments on something, can you negotiate that payment to be dropped by a percentage and pay them back almost half of what you owe? Can you negotiate with the creditor? Yes or no? Oh, type your answers into the chat box, please. can you negotiate to drop down the amount that you owe with a creditor?
Good question.
Awesome. So we have 4 people that participated and are answering, and the answer is yes. The answer is yes, you can negotiate with a creditor, and they will bring down the amount that you owe. Excellent. Thank you for.
Exactly. Very good. Very good.
Another thing I wanted to ask you, Mike, is
Yes.
for example, I know a lot of there are some young adults here, and if they have a checking and a savings, and the banks obviously now with online, you can transfer back and forth between checking and savings so easily. And let's say you don't have enough money to make payments on something that you have, and you keep transferring money from your savings into your checking, and that kind of defeats the purpose of a savings. Is it recommended for them to have a savings in a different bank so that it's kind of like out of sight, out of mind? Because everything is so connected. It's like those lines of what's a savings and a checking become really diluted for a lot of people.
That will definitely be very helpful for some people. It all depends on your level of discipline and what the savings account is for. Remember, savings is sort of short-term needs. So it's something you're going to need in the future, or an emergency fund. So if you are putting money aside for a goal, a specific goal, I would suggest opening a separate account for that. And I sort of touched on that, so that you don't use that money for anything. And it could be the emergency fund. You establish an emergency fund, you put it in a separate account, and you don't touch that unless it's an extreme emergency, or however you define an emergency. But it's always good to have money in a savings account, instead of from a money management standpoint, instead of just a checking account. Number one, because you earn interest on the savings, you can have more money there. So keep as much as you can in the savings instead of the checking. And also, in case of fraud, if you have somebody that, if you become a victim of identity fraud and somebody taps into your account, you don't want to keep a lot of money there and they take it out. Yes, you can claim with the bank that you've been a victim of fraud, and if you report it within 30 days, they'll give you the money back until they investigate, and then they may take it back themselves. But instead of keeping 10,000, say, in a checking account, I would say keep 500 in the checking and 9,500 in the savings, even though you know you may need part of the savings in the very near future, just to protect against fraud, somebody accessing your checking account, and to maximize the earnings that you get on your savings account. So I would say it's slightly different, but certainly the discipline of the person and their goal, it can very well be that a separate bank is much better for them.
Yeah, because we live in an age of immediate gratification, instant gratification, with everything being at a
Sure.
fingertip away. And I know in the old days, you had your savings, you don't touch it, it stays there. But nowadays, you open up your phone and you can immediately see how much you have in your savings, and your checking, your credit cards, it's all right there. So, you just move things around with the tip of a finger, and you basically kind of thrown out or tossed out your plan of having
The
this.
financial plan.
Yep. Yep.
Yeah, now discipline and having a plan is very important, and that actually leads us to this next slide, which is keeping a budget. A budget, pardon me, a budget is the beginning of a financial plan. You cannot plan for something until you know where you are, and a budget is a roadmap. A budget identifies that it keeps track of your income and expenses and allows you to identify what is, what kind of income do I get? What are my sources? Is it salary? Is it business income? Is it inheritance? Is it mom and dad giving me an allowance? Whatever the type of income that you get, Social Security, a disability, a budget allows you to identify the type of income that comes in and when does it come in. So an important part of a budget is, I know I'm going to get 5,000 this month, but I may not get it all at the same time. So an important part of a budget when you're making your budget is to identify how much you're expecting to get and when do you get it. The second part is, how do you spend your money? How do you plan to spend it? And the reality of spending it. So you would identify every type of spending that you do, every type of expense, and when is it paid? You have some bills that are paid in the beginning of the month. Some credit cards would be due on the 10th of the month, some on the 20th, some at the end of the month. So knowing the detail of when something is due allows you to plan for it and allows you to make sure you have the funds you need to pay it, and allows you to pay it on time, actually, so that your credit score is not impacted. So the budget is an account. It shows you what is supposed to come in and when, what goes out and when. Another facet of the budget is it allows you to determine, is this on plan or not? So your plan, a successful budgeting person would set out at the beginning of the month and say, I'm expecting to receive this amount and I will spend this amount and I will save this amount. As you receive the income, you compare it to your plan. I expected to get 5,000. Did I get all 5,000? Maybe I didn't get 5,000. You make a note of that. I only received 4,000. What happened to the fifth? The fifth is maybe because I'm a business owner and I didn't get paid from somebody. So you make a note of that so that next month you'll know that you may be getting 6,000, or you may want to follow up on that person that didn't pay you to find out why. So part of the budget is comparing what your plan is, what you intend to do versus what actually happens. And then you reflect on why. Why did that happen when I didn't budget it? If you don't know and have control over the money that comes in, you really cannot have a financial goal. If all you know is, oh, money appears in my account and I spend it until they tell me, oh, your account is overdrawn, then you have a problem. You cannot plan things in the future. You cannot have financial goals. You do not have control over your financial destiny. And the idea is the budget is a tool to allow you to have a control over your finances and your financial destiny as much as you can. So there's no specific system needed to have a budget. You can have it on paper, just an 8x11 paper, and draw some boxes on it and put it on there. You can have one of the many apps that are available on your phone, on your computer, or some people used to use the envelope system for that the people that remember what their parents used. They get the money, they put in different envelopes. This is for the rent, this is for the money, the food, this is for the savings. And every month they take the money out of that specific envelope to spend only what is in that envelope for that specific purpose. And if that envelope is empty, that means you cannot spend any more on that type of expense. So there's so many ways to aid in the development and keeping a budget. It's up to you It's up to your sophistication, and it's up to what works for you. The goal is to help you have a budget. How you have it is entirely up to you. Now, when we look at expenses, the income is easy. That's good. We know the income comes in and we work hard, we make some more income. Believe it or not, the expenses are not as easy as the income. The expenses usually fall in two categories: fixed and discretionary. What is a fixed expense? The most obvious is rent or a mortgage payment. You will have that every month and it's due on the first. You know it's fixed. You know the rent, well, until they increase the rent, you know how much it's going to be and what day it's on. You have to plan for that and plan around that. Discretionary, on the other hand, is what I would say wants. So fixed can be needs and discretionary wants. What is a discretionary expense? Oh, you know what? I saw this wonderful shirt on sale. I would love to get it. So the getting the check, getting this shirt for me is a want. I may spend the money and get it, or I may delay that and say, you know what? I'm going to have some bills coming up. Let me pay those first, and then I'll see if I have extra income I can use for that expense. So fixed versus discretionary. Discretionary, you have control over it, control over the amount and timing. Excuse me.
Awesome. Okay, so we're kind of getting closer to the end of our session. It's 12:26. I wanted to ask one question in terms of discretionary. Is there is there kind of like an amount, a percentage amount based on your income that you should spend on discretionary income? Because you know, you make $5,000 a month hypothetically, and you decide to go and spend, you know, $1,000 on a purse. Is this a wise decision? Is this like how
Excellent
should one
question.
determine discretionary spending? I mean, I really want this. I love this purse, but you know, I have to pay rent, I have to pay my mortgage, I have to pay all of these other things. How is there a way for young people to learn to what is a good discretionary spending amount on things?
There's item 6 that is referring to exactly what you're saying. 50% would be fixed or needs. 20% of your income should be set aside in savings, and 30% should be in wants, in discretionaries, things that you really want, things that you enjoy. You want to go to the movies, you want to buy purses, you want to buy anything like that. That's what the discretionary ratio ought to be from some financial planners. 50, 20, 30. You have to spend at least half of your income on fixed things that you need. 20% is recommended to be set aside for the future, and 30% on discretionaries.
So let me ask a follow-up question. Do you recommend young adults or youth to get a financial advisor?
Um,
So, for
yes,
example, we have a lot of
yes,
parents right now who are sitting at home and
yes,
they have young adults. We have professionals who haven't moved out, they're living in their homes right now. They don't have rent. They don't have a lot of mortgage or you know utilities bills because the parents are supplying them with free rent, right? But
right,
they have a steady amount of income, and so they're kind
sure.
of like recklessly using this money. What do you recommend for these young adults to do in terms of like having a plan for themselves?
But financial education, and instead of a financial advisor where you have to pay them to give you the advice, I would direct them to certain apps that they can use. There's so much books on one of the best books I started reading is called Money Magic. that's a wonderful book about how to budget and plan your financial security, not just during your earning years, but even in retirement. So there's a number of books. I, I would encourage financial awareness. Financial advisors and financial planners really work or become most important once you have assets. So when you're starting out, you don't have the assets to compensate them by, so you would have to pay for their time to do that. There's it may be helpful, but certainly I would say invest the time to learn the financial on financial apps, websites, blogs, and books to give you that knowledge that you need when you're starting out. We also cannot underestimate the value of leading by example, parents leading by example. If the young man or young woman see their parents simply spending anytime they want, whenever they want, impulsively, not talking about wants, needs, discretionary, fixed, etc., they're also going to grow up thinking they're in the same financial condition and they can do these things. So talking to the children is very, very important. I just want to touch quickly on item 7 for some of our audience, avoiding the cash trap. By that, I mean working off the books. Big temptation for some of the clients, I'm sure at Sabeel, new immigrants that are coming into this country, where people tell them, oh, I'll let you work for me, but it'll be cash. I'm not going to pay you and keep you on payroll. I'll pay you more if it's cash. I call that the cash trap. Why? Because it does not, number one, it's illegal. Number two, it does not build your financial presence in the system. Any income that you earn off the books, you cannot document. So you cannot use to get a mortgage, you cannot use to get a loan, you cannot use to build your credit. So be very, very cautious with that. I know I have many more slides to go, actually a few more slides to go. You tell me if you want me to go forward or you have questions, or we should stop here and to respect everybody's time.
So I think because we originally intended for this to be a lecture series, and so I think that we had a pretty great turnout today. If we take on more of the time, we may discourage from future attendance, and so we should stick to our time that we've committed to and go ahead and announce that we'll have a follow-up lecture in the following month at a time that you and I agree with, and continue the lecture series. This was really fun. I enjoyed myself, and I hope that everyone who attended does as well. We have some comments. Excellent talk. Thank you. Thank you for educating us about these issues. Thank you very much, Mike, for simplifying this topic and allowing us to enjoy discussing finance. So we have some positive comments, and we're really grateful that you came. And I think in the meantime, what I'll do is I'll survey community members and individuals to see things that they questions that they would like answered for the future
Please.
sessions that we'll have. And in addition, we'll follow up and we'll create follow-up flyers for our audience to come and attend, and perhaps our clients as well. We need to survey our clients to see what exactly that they need to be educated on as well, which we didn't have a chance to really do, but we knew what their needs were. And that's why we created this program, to kind of answer some of those basic questions that they may have.
Very good. Well, thank you so much. It was my pleasure to participate, and it was very enjoyable for me, and I look forward to doing this again and answering specific questions. I think that's a great idea.
Okay, excellent. Thank you so much, Mike.
Thank you.
Everyone, thank you for joining us, and have a great rest of your weekend. Thank you.
Thank you. Thank you. Bye-bye.
Bye-bye.